Welcome back, everyone. So, if you are here with me last month, welcome. And if this is your first time, you picked a great one to start with, which today we're going to be talking about where your money should be working. But before we get into the content, I want to be upfront about something, right? I'm not a CPA, I'm not an attorney, I'm not a financial advisor. I'm just, not just, but I'm a doctor and a real estate investor. And I've built wealth using some specific strategies that I'm going to be sharing with you today. It's what has worked for me and what I've learned along the way, right? It's purely educational, it's not advice. And your situation is different from mine. So, like, your income is different, your tax situation is different, your goals are different, what you want to accomplish in this life is different. But what I'm giving you today is kind of a framework, right? A way to think about where your money should be working. But the specific decision that needs to be between you and like your team, whatever that looks like. So my goal is very simple, right? I want to leave you today with enough information and clarity to have like better conversations with those professionals. And if you don't have them yet, right? If you don't have like a CPA or attorney, you should really think about starting to get some of them today. But that's it. So let's get into it. So a quick recall for those of you who were here last month, right? We talked about kind of the investor's identity shift. And we talked about 5 mindset shifts that separate those who are thinking about building wealth from those people who just earn, who just earn a lot of money. And the truth is, everyone here or wherever you're listening, whenever you're listening, makes money, right? But how are we going to start building wealth? That's what we talked about. So if you were not here last month, we will, when we send out this recording, we'll add when we send out this email, we'll add last month's recording as well, so you can watch it at your convenience. But one of the things I told everyone to pick, one of the strategies last month, I said pick something and implement it, and then let's hold each other accountable, right? That's what we decided last month. And I want to know, one, did you do it, right? And if you didn't, is it still something that you can keep yourself accountable and do it? For me, I said I would find an expert so that I'm not doing wealth building alone. And one of the things I did was that I met with a tax strategist, actually multiple meetings, and to think about kind of really how to keep more of what I earn and what I'm building. And so I'm really excited to know how that's all going to play out. And I'm definitely paying a lot less in taxes this year. So last month was kind of that operating system that we talked about. And today is the playbook, right? Because knowing who you need to be is step one, which is that mindset, which we talked about last month. And then knowing actually what to do, how to deploy that capital is step two, which is what we're going to be talking about today. And I think this is where a lot of high earners kind of get stuck. It's not because you don't have money, right? It's not because we don't have money, but it's because nobody ever showed you really like a full menu of options as to what to do with that. So as we get into it, please ask me any questions. If there's something that you're like, I'm not sure, put it in the chat. Send us an email. We'll definitely love to get back to you. But this is the roadmap. First of all, I'm going to show you kind of the default path, right? This is where most high earners, they park all of their money. And I'm going to show you why that caps out. And then I'm going to give you kind of a 4 bucket framework for where to move money into, like how to deploy capital that is going to cover like a full wealth building picture. Again, this is what has worked for me. And I definitely think you should try it out. At least have the conversation with the people, with your team. And then when we do that, we're going to talk about tax strategies that is going to help you multiply all of those buckets that we talk about. So the plan today is to kind of draft like an allocation plan. So not just ideas, but like true plan to help you get started. So let's do just that. Let's get started. So part one is kind of the default plan. So, and I'm not here, hear me, right? I'm not here to trash any financial advisor, but I want to tell you, that the standard advice that a lot of us get is incomplete. And the incomplete advice is like, when we're earning 300, 400, 500 a year, it's costing us millions over like a career, right? Over decades, if we're just doing like the standard advice and the simple thing. So I'll tell you kind of that path, and then I'll show you something different. So this is what a lot of high earners are following, right? The thing you hear is max out your 401k, maybe do a backdoor Roth if your advisor is savvy, right? Or maybe even a mega backdoor Roth. and that's it, right? And maybe the rest is like put the rest in index funds, keep 6 months of expenses in savings, and that's pretty much it, right? Again, this is great advice, right? I'm not telling you to stop doing any of it, but the problem is that that path is kind of it's the best way I can say it is it's optimized for like preservation, right? So it's don't lose money, be diversified, be safe, but it's not really optimized for building wealth, which is what like we want to do, right? We want to work hard or earn a lot, but we want to just not be high income earners. We want to build wealth. That path that I just shared with you, it's not really optimized for generating cash flow. It's not really optimized for tax efficiency, just beyond like the basics, right? So we might still end up paying significant amount in taxes if you go this route. And it's definitely not optimized for replacing like your active income with passive income, which is something a lot of us want to do, right? We don't want to keep working 12 hours a day or longer for almost all of our career. And it's the kind of the financial equivalent to playing defense your entire career, which is like the idea of, maxing out your 401k, index fund, some savings, and then that's it. You will end up doing okay, right? But fine isn't where like you want to be. Like, so as you're in this, you're listening to this, whether it's a recording, you want to be more than just fine. So I want to run that default path, right? I want to run the numbers with you. Let's just say you're earning $400,000 a year and you're going to earn that over 20 years, right? Let's say you max out your 401k every year, right? At 8% average return, which is what you'll probably get. That's roughly like $1.2 million after 20 years. And then let's just say you do backdoor Roth, right? And so that's maybe around 370,000. So you do that, right? And then maybe you put $50,000 a year in a taxable brokerage account of sorts. That together is about like 2.5 million. But remember that you're going to be paying capital gains taxes along the way, like yearly. And then maybe add to that, you have maybe $200,000 that's sitting in a saving account that's basically doing nothing because it's earning like 0.2, right? So if you think about that, right, that's like simple $400,000, maxing out your Roth, maxing out your 401k, maybe doing a Roth and investing, right? So total, that looks like about $4.3 million. And that's on about $8 million in gross earnings that you've earned over 20 years. So that's $400,000 over 20 years, right? If you think about that, right, it's like roughly half of your lifetime income that's captured in wealth. But this is a question that not a lot of people are asking, right? How much of that like is passive income? Like so when you think about that $4.3 million, the ones that are going into index funds, retirement accounts, are they generating any passive income? And the answer is probably not much, right? At least not without selling those assets. And then you can think about capital gains with that. But it's a lot of paper wealth, right? It's wealth that you access by drawing down. But it's not wealth that pays, and you have access to draw that down towards like retirement, right? But it's not really paying you. And it's a solid position to be. Please don't get me wrong. It's wonderful, but I don't think it's financial freedom, at least how we think about it. It's you're going to be comfortable and you're going to depend on that portfolio. You're going to depend on it going up, but and then hoping that like you don't outlive it, right? Because some of those that portfolio, you don't access it until like the 6th decade of life, right? So is that what we want? Do we want to wait till then, right? So this default path, which is not awful, you build a nest egg, you draw down in retirement, that's that. But then I want us to start thinking about maybe like a wealth builder's path where you build income streams that are going to pay you whether you work or not, right? So it's a different goal, a different mindset, a different strategy, but it's different buckets. So this is where I get excited, right? And I want to show you the full framework. This is kind of the core teaching I want to talk about today, which are the 4 buckets. Now, every single one of them is going to serve a different purpose in your wealth building engine or like the strategy that you're thinking about. But I think that you need all 4 of them to some extent. And I don't think it's hard. The 4 buckets. So the first one is tax advantage retirement, which we talked about. Then think about passive real estate, which is something that I talk about and advocate a lot. And then market investments, outside of your retirement account, and then business equity or ownership. So those are the 4 buckets that I really want us to focus on today. And cash reserves are not really in that bucket because they're guardrail. Like you need to have some cash for a rainy day. And then tax strategy is not really a bucket. In each of those four buckets, it's a multiplier. So it makes every bucket work kind of harder. We'll cover all of it, but this really excites me because if you do this well, right, and it's not too late to start. If you do this well, you could really be on your way to building wealth. So the first bucket is tax advantage retirement. So this is kind of your foundation, because every dollar here that you put into here is either going to grow tax free or tax deferred. And it's the kind of highest efficiency place to put money, right? Because it's just because it's tax free and tax deferred, but a lot of us are maybe not maximizing it. So 2026 numbers, and it went up a little bit, right? For your 401k, you can put $24,500. If you're 50 or older, that goes up to $32,500. And between the ages of 60 and 63, you can catch up and you can put $35,750. So you do that, right? That's just the base. Then you do backdoor Roth, and that you can put about 7,500 or 8,600 if you're 50 plus, right? So that's kind of the workaround for a lot of high earners who are over the limit and they can't really contribute directly into their Roth, right? So you can contribute to a traditional IRA, then you convert that into a Roth, and you can do that legally. And a lot of people do this. A lot of physicians, high income earners, professionals do this. So if you're not doing this, right, you're leaving tax-free growth on the table. We don't want to do that. Now, there's even a layer on top of this, right? And it's the mega backdoor Roth. And if there's anything that's really that you want to look into, you want to ask more questions, take a screenshot, and then maybe talk with, again, like the team that you're building. The goal is also that you're not doing this alone. You slowly start building a team, of experts who know more than you, but that can help leverage what you're already doing. Okay, so the mega backdoor Roth, right? This is only if your employer allows you. But if your employer's 401k plan allows after-tax contributions and in-plan conversions, then you can put that, like your 401k contributions, up to $72,000 a year. But not every plan really offers this. But if yours does, right, it's one of the most powerful tools for high-income earners. So you have to call your plan, whatever plan you use, and ask if that's possible. And then like an easy one is HSA. Like if you're eligible to contribute to an HSA, it's $4,300 for individuals and $8,500 for families. But again, this is just like easy money that you can put in and tap into later. But if you do this, like think about it as like the triple tax advantage. So your tax deductible is going in, and then it's growing tax-free, and then tax-free withdrawals for like medical expenses if you use an HSA. So when you add it up, right, like depending on your situation, you could be sheltering anywhere from $80,000 to $150,000 a year in tax advantage, kind of different accounts. I would say this, right? A lot of high income earners are not doing this. Maybe they do the 401k and they stop there. Maybe they add an HSA on top of that, maybe. But you should really be doing all of this. It's not difficult. Talk to your like your 401k company, talk to your financial advisor. I think these are really easy things that we can do. So for every one of these buckets, I have kind of like actions for you to think about. And going into this week, like ask yourself, like, are you maxing out your 401k? Are you contributing up to the 24,500? And like in some plans, you can do this earlier on in the year and kind of max it out. You should be doing this. Are you doing a backdoor Roth? If not, like it's very simple. Talk to your CPA, your advisor. Look into like if your plan allows for a mega backdoor Roth, think about doing that. Most people don't even know it exists. Call the plan administration and ask them, is this possible? Like, do you have HSA access? If yes, just maximize it, right? And then also another thing is like, if you're self-employed or you have a side business income, like do you have a SEP IRA, a solo 401k? Because that, again, opens up like $72,000 in contribution. So look into that. And then, which I'll talk about later, but it's self-directed IRA, right? So Now, with the self-directed IRA, it allows you to invest in real estate and syndications and private equity inside of this like tax advantage wrapper, which I think is just cool. A lot of advisors don't mention it, and it's because like they can't sell products through it. So sometimes if it's not benefiting them, they don't talk about it. But this is why you're here. This is why we're talking about this. This is why you need to know about this, right? If you're doing all of this right, your basic 401k, if you're maybe just like using 30% of your available tax advantage capacity, but there's a lot that's still on the table that you can tap into. So the first question, right, or the first thing to do this week is just think about these things. What am I doing? What am I not doing? What can I add to? And you could get yourself and get it ready for next year. But so that's that. Bucket number two. This is where the game changes, because this bucket, it's the bucket that builds what the default path doesn't, which is passive income, right? It's money that arrives whether you go to work or not, which is why I love this bucket. And so I want to compare, right? You have maybe $500,000 in index funds that's averaging around 8% returns, right? That's going to be about $40,000 a year in paper growth, right? But you don't see that money until you sell. And then when you sell, right, you pay capital gains taxes. So that's that. That's that. You know that you have that. Now, if you take that same $500,000 and you deploy it into a real estate syndication, that's averaging maybe around 15 to 18% in total returns, right? You're going to be getting quarterly cash flow distributions, and some syndications actually do monthly distributions, but it just depends. But that is actual money that's deposited into your account. So plus you're getting that from cash flow, and then you're also getting appreciation when the property sells. And because of how real estate depreciation works, right, a significant portion of those returns are tax advantage. So that's the beauty of thinking about the second bucket. Now, index funds are going to grow your balance on paper, right? And passive real estate will pay you while it's still growing. So you're getting cash flow, you're getting appreciation, and you're getting depreciation. Both of them belong in your portfolio, but one of them is going to really replace your paycheck, or at least add to it. Right. So it's just something I want you to think about. So for those of you who are kind of new here, and maybe you don't know what syndication, how it works in plain terms, right? It's just when you have an experienced operator, so someone who does this full time, they will find a deal. It's usually apartment complexes, and it could be also be commercial property. So maybe retail, office space, self-storage, multiple other options, but they find a deal, they vet it, they underwrite it, they negotiate it, and then they raise capital, right? And they raise capital from investors just like you and I, and then you invest alongside them. So the typical minimum is like 50,000 to 100,000, but the operator is going to manage everything. So think renovations, tenants, property management. You don't have to do any of it, right? The idea and the beauty of it is that you're going to receive quarterly cash flow distribution. This is anywhere from like 6 to 10%. And it's kind of like the cash on cash return. So what you put in versus what you're getting out yearly. And then when the property sells, somewhere between like 3 to 7 years, most times 5 years, you're going to get a share of the appreciation. So what the property went up, what you bought it versus what you sold it, that difference, you're going to get part of that back. And that looks like anywhere from like 15 to 20% on a yearly basis on your investment. So you're getting cash flow plus appreciation. This is what syndication looks like. And this is how I started, right? And this is years ago, I put in $50,000 into my first syndication ever. And then I got 16% returns. I didn't manage the property. I didn't take a single phone call from a tenant. I just invested with an operator that I trusted, and my capital went to work. And then when I saw the beauty of it, right, that's how Phoenix Capital was born. It's doing the same thing for healthcare professionals who want to build wealth. So that's kind of how all of it started. But kind of real quickly, right, when you think about syndications, you don't have to be an expert to invest in syndications, but you do need to know what you're doing, right? And you need to know what to look out for. So I want to quickly talk about 7 things, and then we'll move on to our next bucket. But really, before you invest your first dollar, as maybe you're thinking, I don't have anything in this bucket. I don't have anything in real estate. And I got a text message from a physician 2 or 3 days ago who was like, okay, I'm paying a lot in taxes. I need to invest in real estate. Do you have an opportunity? So people are, the more you learn, right, the more you understand the importance of this bucket. But before you invest, right, you actually need to do some work. So yes, it's passive, but you should do some work before you invest your first dollar. And the seventh thing that you have to look out for, the first one is the operator. So I think this is the most important. You have to ask hard questions. What is their track record? What have they done in the past? How many deals have they done? What happened to the deals, especially when the market went rough, right? Like those are questions you should ask them. Like, secondly, you should understand the market that you're investing in. So like, is the population growing? Is our jobs growing there? Is it a landlord friendly state? Like, do the regulations benefit the landlord? So that, because as an investor, right, you want to make money. So you have to understand that. Third is the actual asset. So like, think about class B, maybe some like class C properties where you can do value add. So you can go in and improve the quality of the property, and then that way it can appreciate over time. That's what we're calling force appreciation. And then the fourth one is the numbers, right? You really have to kind of understand. So when when an operator is doing like a presentation, pay attention. Like are the numbers that they're saying, are they conservative or are they super aggressive, right? If the deal only works when rent is growing at 5%, 10%, right? That's a red flag. You should ask questions, because sometimes rent doesn't grow. Rent might not grow. It might grow by like 0.5%, 1%. So what happens to the deal when it's not making those aggressive assumptions that you made in the underwriting, and that makes the numbers look so pretty? Ask those questions. Five is the structure. So this is also important because I think there has to be alignment. So what is the preferred return going to the investors? What is the profit split? What fees does the operator charge? Like, is it in line? Is it like standard, or are they, like, are they charging acquisition fee of like 8%? Those kind of questions you should ask, and you should be aware. And then six is the debt. So is it fixed? Is it variable? Ask those questions, right? Because if it's variable debt, and like what happened in the last 5 years where the interest rate was going out, it killed a lot of deals. So some of these questions I think that you have to be asking. And then the last one is the exit, right? Okay, so asking, what is the hold period? What is the return? What's the downside, right? Like, if we don't sell, what happens? You don't need to know how to run the deals, but you need to know how to evaluate them. I think probably when I think about a passive deal, right, I think this is probably the most active work you're going to do, which is the work you do before you invest your first dollar. These 7 questions will get you 90% of the way there. And I think that if you ask these questions up front, and if you have a good understanding of these, 7 kind of questions or thoughts, you will invest in a really good deal. Okay, so that was bucket number 2. So I'll keep recapping. This week, right, or kind of before our next monthly webinar, in this bucket, determine your allocation, right? How much capital can you deploy into passive real estate in the next year? Start vetting operators, start asking questions, use those 7 questions to kind of vet deals. And then think about, like, you can invest in these syndications with a self-directed IRA. And that means like your returns, right? Your real estate returns, the cash flow and the appreciation can grow tax-free or tax deferred inside of a retirement account. So people who sometimes you might not have access to liquid cash, but you have access in your 401k, as long as it's not an active 401k, right, you can convert it to a self-directed IRA and you can invest in these deals. So again, it's not something that a lot of people know about. And again, most advisors might not tell you about this because truthfully, they can't sell a product inside of it. So your goal, right, or your target as you're thinking about, okay, what should I do? What can I do? Is to kind of build, I would say, build towards like $5,000 to $15,000 in passive income per year over the next, like, I don't know, 3 to 5 years, 3 to 7 years. And that number, right, is kind of income replacement for a lot of high income earners. So think about what that could look like using this bucket. And again, right, if you have questions, please toss it in the chat. So that was bucket number 2. Bucket number 3 is a lot of people already do this, but it's market investments that are outside of your retirement account. So think like taxable brokerage, index funds, dividend stocks, that kind of thing, right? This is what a lot of like financial advisors, they focus on. I think it's very valuable. I don't think, It's very valuable, but it's just one bucket and not the whole strategy. Okay, so I want to be clear about the role of this bucket, right? It's really, really good for liquidity. So that means you can access the money anytime. The thing about like real estate investing is that it's illiquid, right? So bucket 2 is illiquid. That means that you will not have access to that cash. You'll get you'll get your distributions, right? But you won't get access to your initial capital until the deal is sold. And with your retirement account, right, you're not going to be able to access that without penalties until retirement age. So the beauty about bucket number 3 is that that money is liquid. You can access it anytime. So the money is good for diversification. It's good for long-term growth. When you think about like kind of broad market index funds, it's returned anywhere from like 8 to 10% historically. But it's not really a cash flow engine because it's not sending you distributions. It's not sending you quarterly checks. And I don't think it's like tax efficient, right? Because you're going to pay taxes on the dividend and then you're going to pay capital gains every year. So they send you the 1099 form. And so that's like what you're paying in capital gains taxes yearly. And then after taxes, after inflation, right, the real return that you're going to get is around like 4 to 5%. And there's nothing wrong with that. That's real growth. That's a good number on your money. But if that's the only bucket that you have beyond your retirement plan, I say I without a shadow of a doubt know that you're leaving a lot of money on the table that you could be using to build wealth. So I would think about bucket number 3 as like your growth and liquidity layer. So it's supporting you, like it's like your supporting player, but it's not the lead. That's how I would think about this bucket. And I think it's very important, but it's not the only thing. And so, the kind of your move for bucket 3, right? This is how I would think about it. And this is along, of course, with your financial advisor, but automated, low cost index funds, think like total market, international, maybe some bonds. And then think about like, tax loss harvesting when you can. So like if you have losses and you sell those losses, then they can help offset your capital gains taxes. But I would say don't over allocate in here just because it's comfortable. You got to do some work. Many high income earners, right? They have like 90 to 100% of their non-retirement capital in the stock market because that's what the experts that they work with recommend. That's not diversification, right? That's just you're concentrating everything in one asset, and it has like mediocre tax efficiency. So I would say don't do that. Rule of thumb is like if you have more than 80% of your non-retirement and that's invested in the public markets, your portfolio is not balanced, right? You need to have those other buckets that are working for you. And so that is how to think about the importance of bucket number 3, but also how to think about the other strategies. So this is bucket number 4 that we're going to be talking about, and it's ownership. So how do you start thinking about a business ownership? What does that even look like? And this is the part that really excites me because I like talking about this. And so this is what the data shows us about ownership, right? 79% of millionaires are self-made. And that means that like the Federal Reserve found that business owners had higher income and a higher net worth than non-owners at every single income level. So that means like in some way, shape, or form, right? Think about owning something. And owning something is the single biggest differentiator in wealth building. And I don't just mean like go start a tech company. I don't mean that, but like the ownership menu for us professionals are very wide. So you can build a business around like your expertise, like whether it's consulting, whether it's coaching, digital products, content, real estate, owning a practice. You can even buy, I spoke with a physician who is like an expert in buying existing businesses. So you can also do that. You can build a personal brand that will generate revenue. You can invest in private companies. And most of the people who are listening to this or who are in the room right now, they have deep expertise in something. Can you use that to do something? Can you leverage that? And so the question that I want to ask you about this bucket is that, are you only selling your expertise as labor, or are you also packaging it as equity in some form or shape as a business, right? You should be thinking about that because labor, using your expertise in labor form will get you income. You get paid for doing that. But when you start thinking about equity, right? Equity builds wealth on every single income level. So um, that's something to think about, right? And I want to show you how this plays out for someone like maybe many of you in the room, right? So the first stage is like you're earning. We said we use $400,000 as a doctor, right? You're making great income, but the only equity that you have is maybe your home. So then that's the first stage. And then the second stage, you start deploying it into syndications. Maybe now you own real estate, you get some cash flow. And then the third stage, right, you take your expertise. So maybe it's clinical, financial, like whatever it is, and you build something around it, right? Maybe you start your own practice. Maybe you start a clinic. Maybe you start a community. Maybe you start a course. Maybe you start some sort of advisory consulting business, right? The list is unending. But this is kind of just the things that I thought about and I came up with. But when you do that, right? So this stage, now you have some sort of business equity. And then the fourth stage, like it's your investment plus your business plus your professional income, right? So now you're having multiple streams of income. That is how you need to think about this, right? You now own the means of production like across three or more sources. That is how wealth is going to start being built. And that's exactly what I did, right? I didn't leave medicine. I just added ownership on top of it. So then I was an ER physician, real estate investor, built Phoenix, My Expansive Life, and none of those replaced medicine, but they all compounded on top of it. So this is kind of bucket number 4, right? This is the action plan. Audit your expertise. Like, what are you good at? Ask yourself, like, what is something that you know that others might pay you to learn from you? Do you have that thing? All of us are experts. Maybe you just need to learn how to like package that and then kind of sell that, right? I think about this, and I can't remember who told me this, but when you have value, when you have something of value to give, right? The exchange of value from it is very easy because whoever is getting that value feels like it's very worth it and they're okay to like give you something for that. So think about that, right? What is something that you are an expert at that people would like kill to learn? Then ask yourself, when you figure that thing out, then ask yourself, like, am I monetizing that through just showing up to work, right? And that's like your income. Or could I package that into something else? So this is what the bucket number 4 is. Like, you don't have to quit your job, right? You don't have to start a company tomorrow. You could just start small, start thinking about it. A lot of us are young. And so like, it's not too late to just think about what other options you have. But again, right, I said it could be a consulting gig. It could be like digital product, a community, just something, but start thinking about that, right? Something that you own the asset, you own that thing. You're not just renting your time, right? And the goal is, again, it's not to replace your career, but it's to add ownership on top of that. And I think that's why this bucket is very important. So those are the 4 buckets. And I quickly want to talk about this, the tax multiplier, as we start wrapping up. But if you have any questions, please toss it in the chat. So this kind of section, I think it ties all the 4 buckets together, which is like tax strategy. It's not a separate bucket, right? It's kind of again, I said the word multiplier, but it makes every bucket work harder. And I want to quickly talk about it, right? If you're earning $400,000, you are most likely giving up $160,000 or more to taxes every year. That makes me so sad. And that's even before you invest a dollar, right? The wealthy, they don't earn a lot more than us high income earners, right? They just keep a lot more of that money and they do it through the tax code, not around it. So when you start thinking, each bucket, right, has a lot of tax advantages. So bucket number 1, which we talked about, which is retirement, right? It's going to reduce your taxable income directly. So put more into that bucket. Bucket number 2, which was real estate, it's going to give you depreciation. So real estate losses on paper, that is going to offset your income, even though the property is appreciating. That is another tax multiplier, right? Bucket number 3, this one's a little bit harder, but like I talked about tax losses that you can harvest. So you can sell at a loss to help offset your capital gains tax at the end. So that's an option. And then bucket number 4 gives you like a lot of entity structuring options. when you start the business. And so your CPA and your tax strategist will help you think through that. But that's the idea, right? The right tax strategy, not one that is aggressive, just really strategic. It can save you $30,000 to $80,000 a year. And I'm starting to see that, right? I'm starting to really see the benefit of real estate investing in my taxes specifically. There will be a time in the very near future that I probably won't pay taxes anymore. And that excites me because, like, again, right? I told you this is just education. It's not advice, but it's what has worked for me. And so over the next like 20 years, right? That when you think about it, right, that's $600,000 to 1.6 million that is not earned, that is saved if you start really deploying tax strategy in your buckets. So this is like the one critical action, right? You need to find a CPA that really understands asset-based tax strategy. So we are past the point that we use like someone who just files your returns, or you use TurboTax Online. Please don't do that. Just reach out to me. But we have gone past the stage of doing just that. You have to have someone who is proactively structuring your finances to maximize what you give away, right? If your CPA has never mentioned cost segregation, depreciation, entity structuring to you, I would say maybe you should start thinking about looking for someone else, right? Because you have an expert, right? Or you pay an expert so that they can tell you the things that you don't know. And so you need to have someone who is an advocate for you and are thinking about like the right tax codes for your situation. Okay, so this is kind of the last part, which is like your allocation plan. And I just really want us to think about where you are. You might be here listening today, or you might be listening to this online. I know someone asked if the recording will be available. The answer is yes. But you might be here thinking, how do I do this, right? So I want us to build a simple plan. And I would say take a screenshot of this, but this is kind of the framework. You don't have to, like, you can screenshot it, you don't have to fill it out, you can write it, but as you're kind of just as you're going about your day, right? I want you to actually think about what this could look like, what you need to change. Start with your gross income. And a lot of us know that because it's tax season. So you have all the documents around the corner, but take away taxes, subtract living expenses, and what's left is your kind of your deployable capital. The good thing is that as high income earners, you have residual income. And the question is, how do you start thinking about allocating that intentionally across these 4 buckets? This is very simple, but it's going to, like, this whole assignment is super simple, but it's going to help you start thinking about what's possible, right? So the bucket number 1 first, max out your tax advantage space. So if you're not doing that, do whatever you can to reduce your taxable income. Then bucket number 2 is kind of real estate. So passive real estate, that's where cash flow lives. So I would target like maybe 25 to 30% of your deployable capital into that. And then bucket number 3 is market investments. For me, that looks like, again, that looks a little less. So that's like 15 to 20, 25%. And then bucket 4 is business equity. So even if it's 0 right now, right, at least just start thinking about maybe having a plan. Or what this could look like. I would say just start thinking about it. And then with this, kind of have your cash reserves. You should always have 3 to 6 months of expenses just in case. There's some people who are a little bit more risk tolerant and would do 3 months, but I just think, like, you don't know tomorrow. And what I've done, again, it's what I've done, right? Doing 3 to 6 months makes me feel a little safer because I don't know tomorrow. So anything beyond that is like capital that's sitting idle. So don't allow more than that in your savings account because it's making you nothing. So the point of this is like, it's not perfection, right? It's just intention. I want you to start thinking about it. A lot of high income earners have never written down like a capital deployment plan, but this is active, right? You have to, if you're not thinking about it, then you're not really doing the right things for your money, your hard-earned money that you work hard for. You might be going to work at 2 a.m. in the morning, right? So you know how hard it is that you worked. Think about this. A lot of us kind of just earn, spend, and then save whatever is left and then hope for the best. We should all be done with that, right? We don't want that. Fill this out, or at least think about it, right? Start thinking about it, start having conversations around it. my goal, my heart is that our community will build wealth together, right? So whether it's investing through Phoenix Capital, whether it's thinking about starting a business, whatever that looks like, right? I want us to start really, really thinking about building wealth together. So this is at least a good way to start asking those questions. And so as we wrap up, I want to show you what 20 years looks like side by side, right? Same income, same career, but kind of a different deployment strategy. So again, I told you that the default path is like, if you had $400,000 every year, if that's what you're making over 20 years, right? You're going to get about 4.3 million. That's solid. That's really good money, right? But there's minimal passive income and it's like basic tax efficiency. Now, when you think about this 4 bucket strategy, right, you're going to max out your tax advantage accounts, so those retirement accounts. You're going to have consistent real estate, maybe through syndications, and then you have good market exposure, maybe some business equity that's built over time, right? With this, right, done well over 20 years, it'll get you around 6 to 10 million or more, right? And then start thinking about like 15,000 to 20,000 per month in passive income. And I would say we're young, right? So I can use the word aggressive, but like with aggressive, legal, please, everything should be legal tax optimization. And then thinking about like multiple streams of income, right? Same person, same paycheck. The only two difference is like where your money is working for you. And my heart is like with this framework, right? With thinking about the 4 buckets, maxing out your tax advantage accounts, real estate investing, business equity, good market exposure. I think that's the power of this framework. And that's how to start thinking to go from just like what everyone else is doing to what we are doing. So this is where I'm going to leave you, and then I'll open it up for questions. Right, your money is going somewhere every single month, whether you like it or not. The question is whether it's going where you have decided that it should go to, or whether it's just going where it's always gone by default. Like, where is the money going? How is it working for you? So think about kind of what we just worked through. Find out the allocation plan, like find out what your allocation plan this week is, and then maybe pick 1 bucket. If you are brave, you can put 1 bucket in the comment that you're thinking about improving on, but take one action, right? Next month, when we think about it, be ready to report and tell me kind of what you've done. And I will also keep you accountable because I will say what I've done, but I've been very proactive about thinking about where my money is going and how it's working for me. And so I want to say thank you. Thank you so much for being here. This community, what we're building, it's our edge. This is where we come to learn. And then we have the knowledge to go out and make the best informed decisions that we can. So thank you so much for your time. And then I'll see you next month. But before I leave, if you have any questions, right, just put it in the chat. If there's something that you need help with, whether it's tax strategy, how syndications work, what this allocation plan could look like, just toss it in the chat if you have questions, or we can set up a one-on-one and kind of just talk through your situation and figure out how we can align together. But go ahead and like just toss any questions in the chat. But thank you so much for your time. And I really enjoyed having this conversation with you and being able to share some of this. The question that came up is this recording available? Yes, we will have this recording available within the next 24 to 48 hours, and you will be able to have access to it. And also, we'll put out last month's webinar as well, just so if you weren't there and you weren't able to listen to it, you can get kind of a framework and the mindset to be able to like fully understand this second webinar, which is a capital deployment plan. So where your money should be working, how it should be working. Okay. If there are no other questions, thank you for spending the Saturday afternoon with me. If you have any questions, again, I will, let me see if I can, I think you were able to see my contact information, but I will put it up one more time. Okay, great, perfect. So this is my contact information. If you feel free to reach out to me, and then we can connect and go from there. Okay, well, everyone have a great afternoon. Bye.